This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. We're back with Week 10, or Episode 10 of the Rational Reminder Podcast. I had a pretty interesting weekend. Well, not that interesting. This is not the first time I've done this, but we picked up a quarter of pasture-raised beef.
So which quarter, front or hind?
Front.
The front?
We always do the front.
Yeah. I was a butcher in a past life. That's why I'm asking.
Yeah, you know all about it.
So why the front? Lots of ground beef?
Like the cuts, yeah. We did a lot of ground beef. We had half of the ground beef made into sausages. And then we got a bunch of roasts.
To do in the Instant Pot.
Maybe in the Instant Pot. I don't know. We got the prime rib you have to do in the oven, I think. You can't do that in the Instant Pot.
No.
I did a blade roast on the weekend, which was great.
Well, the blade in the Instant Pot is phenomenal.
But it was a 180-pound quarter. So it was a big quarter.
Right.
$1,600.
So what's your main reason for doing that?
Well, it's
economics or quality?
Quality first. Well, quality is why I get the pasture-raised beef. Like grass-fed, grass-finished. It's totally different ballgame than the kind of beef you'd buy at like Loblaws. I haven't bought meat from a grocery store in years.
So when you buy it, do they age it for you?
None of this was aged.
Okay.
They butchered it, and we got it the next day. Frozen.
It's all frozen.
Yeah. So quality for grass-fed or pasture-raised. And then the reason for doing the quarter as opposed to buying it bit by bit from the farm is that it's cheaper.
Terrific. So last week I was out west, as you know, so I got back late Friday night after visiting 4 other offices out west that are in the same business as we are in. So we're part of a quasi peer group, I guess, where everyone's willing to share how they manage their practices and how they work with clients. And it was a terrific trip. 3 offices in Calgary and 1 in Vancouver. And it's amazing the quality of people that are doing work like we are across this country. So we've known a lot of these people by being at various conferences over the years, mainly in the DFA type world. But still, you always learn stuff about how to deliver better service from these people, and not only from the formal presentations, but we also meet up afterwards and go for dinner. So it was a terrific trip.
What was your biggest takeaway in talking with other people doing similar work that we are?
One big takeaway was there was a number of bank-owned firms we visited who, just based on the size of the bank, they don't have the flexibility. For example, we're doing a podcast now, which in a bank environment, I think would be tough to do just to get approval on compliance. So we're able to be more, I think, creative in how we communicate ideas to clients. Like the idea behind this podcast was really for clients to get an insight into our practice, not so much about marketing. So we have, small firm, boutique type firm flexibility to do a podcast or your YouTube channel.
Right.
Or the various different events that we do, which are very hard in that kind of environment. So I think they're frustrated with that. But, being part of a bank, you get their brand and a certain amount of, business development support from them based on the brand. But I think our team really, really appreciates being part of a kind of a private, creative, like we get to create our environment. Like even our physical environment, you can't create in a bank branch. You're part of a branch largely.
Right.
So people have been here. They know our meeting rooms are designed, specifically with clients in mind, and our working space with couches and whatnot. It's a little bit more creative, reflects who we are, which I think is very nice.
Do they talk at all, being at a bank, do they talk at all about sales pressure or anything like that?
No, these are all high-performing teams. So there's no issue of pressure on sales at all. They're just as professionals as we are in our investment philosophy, just as disciplined as we are, high-quality people. All 4 of those teams I would deal with personally if I.
So what do you think when you think about teams like that and like-minded people? What do you think keeps people like that at a bank as opposed to seeking out a firm like PWL?
Well, that was kind of the burning question, right? I don't know what the answer is because you leave a lot of revenue on the table for the banks, right? So you can go out on your own and arguably perhaps do things a bit cheaper for clients, although the market basically dictates what the fees are. I would think the fear of the unknown. When you're at a bank, it's going to be solid. Like if you're an advisor at RBC, RBC is going to be there. I think there's a certain amount of cachet with clients who are RBC people. So I'm sure there's people who won't deal with us because we're not a big brand name like that.
No, that's never come up.
It's never come up, but I think we've got selection bias,
True.
right? We're getting a lot of people who don't want to deal with the banks.
Right.
Right? I agree. I've never had that issue come up before, but if you were a bank type person, you would never talk to us anyways.
True. Right. That's really interesting.
Likewise, if you're an independent minded type person, you would never talk to a person in the bank. So we end up with, selection bias and who we get.
Wow.
But quality practices, quality people. They say it's really weird working inside one of the branches. They're one team out of 62 advisors. He says there's basically us surrounded by 61 active managers. It's just crazy to me how you can work next to people that don't believe in what you believe in, but I guess that's what makes the market, and they seem to be all okay with it.
The thing that blows my mind is why would that team, one out of 60 some odd teams who have different philosophies, why would that one team that thinks the way we do not want to join our platform? Interesting. That's a big problem for another day.
I don't know.
Because that benefits everybody. Then the firm PWL as a firm gets more scale. It works better for everybody, including clients. Anyway, like I said, bigger problem for another day. So as everyone knows, or everyone that listens, we had our first guest on last week, and the process was great. The guest we had, Carson, was fantastic. Not rehearsed at all, but sounded so professional.
We kept talking afterwards off mic, and we could have kept the tapes rolling.
Yeah, we kind of wished almost the second half of the conversation was more interesting, but next time. But based on that experience and the feedback that we got from listeners, we're going to continue having guests interspersed throughout the episodes. So we've got a few really great ones lined up that we'll talk more about as we get closer to those episodes.
So this first topic's got you pretty fired up, I know.
Yeah. So for today, I think it's pretty obvious. I bet a lot of our listeners could guess what we're going to start off with. But the Ontario government's come out and said that they're no longer going to back getting rid of the deferred sales charge. So this is some proposals that went through, and it looked like they were going to be approved, and we were going to be done with deferred sales charges in Canada. For anyone who's listening who doesn't know what that is, deferred sales charge is like if I'm an advisor selling a DSC, deferred sales charge mutual fund, I sell it to the client, I get a big 6 or 7% upfront commission in my pocket that day, and the client then has to stay in that fund, or at least with that fund company, for 6 or 7 years.
And I remember when that was created back in the early 90s by McKinsey Financial.
Wow.
And that was what really kicked off the mutual fund revolution. Chilton's book had just come out, The Wealthy Barber.
Right.
And I remember going to road shows from these companies, and McKinsey actually funded it by selling limited partnerships. So you could sell a limited partnership, which raised cash to finance the back-end loads. You sell a limited partnership, get a commission on that, and then sell a fund and get a commission on that. And I understood the argument. It's going to force you to be more a buy and hold investor because you're not going to sell if you know you have to be in for 7 years. Makes you wonder then, well, what's the advisor doing? Isn't that the advisor's job?
That's exactly right.
But we didn't know any better. This is going back to 91, 92, 93. And that's what first tipped us off to look at going fee-based, because we were getting clients as they were being let go in that big release from the federal government back then. And you'd pick up someone with $100,000 severance, and all of a sudden you're getting a $5,000 commission.
That day.
Well, it would show up like a week later, but for one, maybe two meetings and a little bit of paperwork, and all of a sudden you do a 200 and then a 200 and then a 200. You're making $8,000 to $10,000 often, and it's like, yeah, I think we're pretty good, but we're not this valuable. So it just felt totally wrong. So that's when we started to look out, for options, and decided to go fee based after that.
Yeah.
But it was a huge boon. I remember people writing $1 million tickets. Like not in our firm, but I knew of people. They're making a $50,000 commission.
Yeah, I remember even when I was in the mutual fund business for that year and a bit, I saw people doing similar stuff.
But I was stunned that the government went against what the industry recommended, and I think they've squished it, right?
That's what it looks like. Yeah, I don't know how explicit the wording was, but as far as I could tell, it looks like it's done. The decision's been made to not move ahead with a ban.
And then you found out what the head of Advocates.
Yeah, well, Advocates posted didn't do any fancy digging or anything. They posted a release. I'll read a quote from, so Advocates is an industry lobby group that represents mostly mutual fund salespeople. Like when I was in the mutual fund business, you were strongly encouraged to join Advocates and be a member and all this kind of stuff. So their statement said, "Our intention as an association is to ensure Canadians have equal access to trusted financial advice. Today's announcement by the government demonstrates that the Government of Ontario shares that vision and intends to work alongside stakeholders to protect consumers."
Wow.
Then he carried on and said, basically arguing that because people have small accounts, like on average Canadians have less than $25,000, 80% of Canadians have less than $100,000 to invest, and they're basically saying that with that amount of money to invest, you can't access professional financial advice unless the deferred sales charge exists. That's their argument.
Nonsense.
It's absolute nonsense. And when you think about somebody looking for investment advice, if the only way they can get advice is by buying a high fee product that's terrible for them in the long term, they don't need that. They're better off with no advice.
With the options like robo-advisor or the Vanguard one decision balance funds at whatever 25 or 30 basis points.
Exactly.
It'd be cheaper to charge them $1,000 or $2,000 for the advice and to jam them perpetually into 2.5%.
Yeah. So with the robo-advisors, and there's some interesting firms popping up now that are either fee-only, and there's some other ones that are fee-only with a subscription model. I don't remember the name, but I saw one of them recently. It's like $40 a month for ongoing financial advice. And that's pretty interesting.
And I was shocked. I listened to a podcast, and we should put it in the show notes, with Michael Kitsis, who's a consultant to our industry. So he was interviewing Rick Edelman, who's the founder of Edelman Financial, which is a $20 billion firm, much similar structure to us in the U.S. They don't believe in minimums. Their minimum is $3,000 account. And he says, either you care about helping people or you don't. I mean, it's common in our industry to try to aim higher all the time for efficiencies, but his approach is totally different, and he is growing like crazy in the U.S.
Yeah. In that statement from Abacus, one of the things that really kind of set me off is they say that getting rid of the DSC would be restricting access to professional financial advice. So to me, I say, okay, what does that mean? You start looking at what does it take to give that type of advice that they would be banning. So basically, what does it take to sell a mutual fund? If you go through the Canadian Securities Institute, they have one exam that you've got to take, and they estimate between 90 and 140 hours of study to complete this mutual funds licensing exam. And then after that's done, you're required to do a 90-day training period. And then that's it. Then you're licensed to sell mutual funds. So when we're talking about getting rid of DSC, and that's gonna restrict access to professional financial advice, is that professional financial advice? Is that what it takes to be a professional? 140 hours of study and a 90-day training period? I certainly hope that's not it. But that's what they're arguing. So anyway, I don't think that any consumer is being wronged if they don't have access to somebody who's spent 140 hours studying so that they can sell high-fee mutual fund products.
Thankfully, I don't think DSC is as big a deal anymore in the industry.
Investors Group killed it. Investors Group is no longer doing it.
I don't know how much sales are being done DSC anymore. We rarely see it coming in. Once in a while, we'll see a DSC.
It's still a big chunk. If you look at the buy assets, the amount of assets in Canada.
Oh, for sure, where money is. I'm saying new money. How much new money is going? I don't know.
I don't know either. It's tougher now. I mean, CRM2, I think, did a lot of the work by explicitly showing clients how much they're paying. So if you go and do a DSC on $1 million account and you get a $50,000 commission, the client's going to see that in their year-end statement.
But this gets to the other issue, which I know you want to talk about later with the CBC story. But people have to be aware. Like, think of the amount of money that's in DSC funds, or the DSC is melted away, and they may be able to move over to lower cost type options like F-class options or something. I can only imagine how many people just have no idea they're in a DSC fund and the DSC has gone.
Yeah, people don't even know they're in a commission fund. People don't know they're in an active fund. Most people don't even know what an active fund is. I would wager.
Or a lot of people might be in a DSC fund, and what typically an advisor will do is once the load schedule is over, they'll flip you to the A-class fund to get the higher trailer.
Well, they'll do 10% free every year.
10% free, and so instead of getting a 0.5% fee in perpetuity, you get a 1% fee in perpetuity.
Well, break that down. So when the DSC is applied, two things happen. You get an upfront commission, But then your trailing commission, which is your ongoing commission that you get monthly, and it's quoted as an annual percentage, drops from 1%. So if you don't do the DSC, you get a 1% trailing commission. If you do the DSC, you get the big chunk up front and then 0.5% ongoing for service and things like that. DSC allows you to so take 10% of your units each year and remove them from the DSC fund without penalty. So a lot of the times what the practice is, and I don't have data on this, but from experience I know the practice is you do the DSC in the first year, and then each year you take the 10% free and you flip it into the regular A-class fund so you get the higher 1% trail. And that's how you do it. That's how it's done. It's all about generating higher commissions. Now, I guess, to be fair, in that instance, even though the client's getting screwed anyway, but they're not getting any more screwed with the 10% free.
If you see value, that's the value's in the eye of the payer, I guess.
Yeah.
But you're not paying any more, but your advisor's getting paid more. So I guess your advice should be going up over time. I don't know.
So all this stuff is going on. It's been the last 6 years that the consultation on trailing commissions and DSC has been going on, and we've had new disclosures come out, and all this is happening in the world. And groups like Advocates are fighting to keep DSC and fighting to keep trailing commissions because they're arguing it gives investors more options for advice and whatever. While all that's been happening, PWL has grown from managing about $700 million 5 years ago, and now we're just under $3 billion today. And we are doing fee-based, we are doing evidence-based portfolio management. Our costs are low. I mean, even when you look at our peer group, our fees, the fees that we're paid for our full-service wealth management service, we're aggressive in pricing. Our portfolios are cheap because we're using index funds, and people want that. So if advocates and mutual fund advisors and those types want to continue selling high-fee products and using DSC and using trailing commissions, they're going to die out.
Yep. And even things for efficiency like e-sign option for new paperwork and using vaults. These are things that are not implemented yet in the banking world. For sure it's coming, but I learned last week, I think we're pretty progressive on some of the technology, believe it or not. And all these things enable us to keep some of the fixed costs lower. We're not in the highest rent district, certainly in Ottawa, but we have a nice office. We invest heavily in people, which is what really matters to clients, I think.
But I think the point is if the industry wants to hang on to commissions and stuff like that, that's fine. But they're going to lose clients. I talked to somebody last week who is in that model, and I can't remember the exact wording that they used, but they said something, and they had a sizable account, but they're in DSC mutual funds, and they said something along the lines of they wanted to get out of the old financial advice model. And I think people are starting to see it that way. The old rolling over DSC funds, the traditional financial advice model, I think that's, in the eyes of consumers, I think that's becoming obvious that it's going to die out.
But I think that's why people are finding us through non-traditional channels. If you realize there's something wrong with your portfolio, instead of going asking your neighbor, which is kind of the old referral model, I think people are just going to the internet and finding us, hopefully, that way.
Right. Yeah.
So with that, we kind of linked in the story from this great video that the guys at Ritholtz Wealth Management put out, talking about the change in the fiduciary rule in the U.S. So basically, a rule is proposed in the U.S. that has basically been killed that would force all financial advisors to act in their client's best interest. And so the guys at Ritholtz used to be very aggressive about promoting this new proposed rule and say this is what must happen. They still believe that, but now their tact is basically, you know what, go ahead industry. If you're going to be this stupid, we're just going to eat your lunch and basically get all your clients. That's the way you want to be. And this video, which I hope we put a link to in the notes, is pretty incredible from some pretty savvy people with millions of followers. They're coming out swinging, saying, "Go ahead, don't make people work in their clients' best interest. Have fun."
Yeah, they're saying if you're gonna go after the interests of your clients, then good luck.
If you want to lobby, the quote is, if you want to lobby against your clients, go ahead.
Yeah,
our firm and our movement will win because it's the right thing to do.
It's the same thing we're doing. We're not as maybe American and aggressive about it. We're a little more Canadian.
Yeah, Josh Brown's pretty aggressive about it for sure.
Yeah, very New York American. We're a lot more Canadian, but it's a similar approach. We're doing the same kind of thing, and the end result, the assets are still flowing to us. Like the growth that we've seen in the last 5 years has been unbelievable firm-wide.
But this next topic, you're kind of pro industry a bit. Right?
Well, yeah. So I'm not the first person to have this opinion. Rob Carrick wrote about it a while ago. But CBC had a big go public sob story. Sorry, that's offensive to the person the story is written about. I didn't mean to be offensive there, but the fact is, the story is about someone who is self-described as a sophisticated investor, which I take issue with alone. But anyway, they are complaining that they have been paying trailing commissions by owning A-class funds while having their assets at a discount broker. So the reason there's a disconnect there is the trailing commission on an A-class fund, that's the 1% trailing fee that we were talking about earlier. That 1% is designed to be for ongoing service and advice. Now, a discount broker is legally obligated not to give any advice. So if you own an A-class fund
You're paying for something you cannot get.
You cannot legally receive. Now, I do agree that is wrong, and that's one of the things that regulations are going to address. So that as far as I know, is not going to be changed by the Ontario government. That will go through. So discount brokers will not be able to offer A-class, or they won't be able to receive commissions from A-class funds. They might have to rebate them. I don't know. Now, there are these things called D-series funds, which are designed for DIY investors. I don't know if people realize, like when you read that CBC article, it seems like the D-series funds have no commissions. That's not true. They still have embedded commissions. They're just a bit lower. The only way to get no commissions is with F-class funds, but you can't buy F-class funds through a discount brokerage.
Exactly.
Yeah. So the point of talking about this story is that I don't feel bad in the slightest for somebody who has purchased A-class funds through a discount broker. You should not be crying about that.
You went the DIY route.
That's right.
You're the why.
That's right. You've taken on a very important decision. I mean, we talk about, and we'll talk more about this in a minute, but the money is so important. Love it or hate it, it is what it is. The way that the world is structured right now, money is exceptionally important. And investing is an important part of money. If you're not investing, then you miss out on the gains of capitalism while the rest of the world doesn't. So if someone's taken on this massive task of being a DIY investor, they better be doing a good job. They better know what to do. They better do their research. And for someone to come out and complain, well, I didn't know, I bought the wrong, like, too bad. What's the difference between that and buying like an oil stock? Oh yeah, I bought the wrong, I didn't mean to buy that one. It just doesn't work that way. So anyway, I have zero sympathy for someone who's taken the route of being a self-directed DIY investor and has been paying commissions. I agree it should be fixed, and it will be, it has been, but you shouldn't be complaining. That's a big undertaking, being a DIY investor.
You're on record. And
you look at stuff like the Canadian Couch Potato blog, that gives you a pretty explicit and easy to implement way of being a smart investor. Like, it's not perfect in some ways, but all things considered, it's pretty good.
Yeah, if you're DIY, what are you doing in a high expense ratio active fund anyways, right? When you go buy an ETF portfolio for a dime.
Well, I saw some data on online brokerage accounts. The majority of assets in the accounts are individual stocks. Only 7% of assets in self-directed online accounts are mutual funds.
It must be a ton of cash too,
9% cash.
Oh, that's all.
Yeah,
I thought it'd be more. They make money off cash in the overnight.
But it's mostly individual stocks. So that's the other thing. Like, you've chosen to be a DIY investor and you're investing in mostly individual stocks. Is that any better than buying? Like, maybe you might have been better off in the A-class fund as opposed to buying a bunch of oil stocks or something like that.
Was it relative absurdity?
Yeah.
A couple surveys you found one and I found one last week, just talking about what's causing stress in people's lives. And for many people, money is a huge stress in their life. So the one that I found suggests that 36% of people have money stress in their life, and yours is a little bit lower at 33%.
Same idea, though. Yeah, the one survey that I found came from Wealthsimple, and you had the one from Bankrate. But you found a story from Jonathan Clements, who used to be the personal finance columnist for Wall Street Journal, and now he's got his blog, humbledollar.com. And he wrote a nice little piece about the Bankrate survey. He suggested, if money is a major stressor for you, then you should turn to a fee-only financial planner who acts in your best interest for advice, or speak to a nonprofit credit counselor if it's a debt issue. Make a plan of action. So you've got to actually make a plan, implement it, execute it, and cut back on expenses. Those are his.
Yeah, so money stresses aren't just about retirement, although that is the big one. And as you get older, the money stresses go up. But it's debt, ability to pay your bills,
Education
kids'
costs.
education costs, and in the U.S., of course, would be healthcare costs to be up there. So it's that whole basket of stresses. But as you get older, like that young baby boomers, the big stress is saving enough for retirement. We live that every day.
Yeah. And this kind of ties back to the DIY conversation. Like, does the average person save enough? They probably have no idea because they probably don't know how much they need to save because they haven't done a financial plan.
And so many people, how much you save matters way more than how much you earn.
How much you earn, how much you pay in fees, how much your returns are. The savings rate is arguably more important than all of those things. Which, in a way, to tie it back to the advocates thing, is maybe an argument for paying high fees to a DSC fund so you can know how much to save. I'm just joking. That's not actually a good argument for that. I think it's, just on this survey, I think it's totally normal for money to be a source of stress. Like I said a minute ago, it is, love it or hate it, is one of the most important things in our lives. To a point. Obviously, there are diminishing returns after a certain level of income and wealth, and there's been lots of studies done on that. But financial stuff is hard. Budgeting's hard. Making smart purchases is hard. Saving is hard. Investing is hard.
Delayed gratification.
And I was thinking about this before the show. I think one of the reasons that all that stuff is hard is because everybody wants to take your money from you, because we're in a capitalist society. Everybody out there wants to take your money from you, and they make those decisions hard so they can get your money.
Everybody from Amazon to your farmer with the beef to
I think your
car dealer to, there's choices, right?
I trust my farmer.
Well, of course you do. This isn't about trust, but it's appealing in a capitalist society to get this stuff.
Right. I've been listening to the book Smarter, Faster, Better by Charles Duhigg. The subheader is The Secrets of Being Productive in Life and Business. It's an interesting book. But the book talks about locus of control. And if you have an internal locus of control, you're generally more satisfied with life, less stress. And what it means is if you have an internal locus of control, you take responsibility for everything in your life, as opposed to focusing or having an external locus of control where you blame external factors. So I was thinking about that in terms of personal finance and investing. If you have an internal locus of control, you will save because that is in your control. You'll minimize your investment fees, so like seeking out stuff like index funds. You'll seek advice as needed. Someone with an external locus of control would be more likely to not save and hope for higher investment returns, which would lead them to active management, hoping for better returns, even though statistically they're unlikely to get them. And then blaming bad investment advice when the returns don't work out.
So what do you mean by locus of control?
I don't know. It's a term in psychology. The book talks about it. Locus of control just means, it's more of like how you frame your interactions with the world. If you have an internal locus of control, it's like if you didn't get a job that you wanted, it's because you weren't prepared enough, not because the interviewer was a jerk.
Oh, I see. Okay.
Yeah.
That's really interesting. Hadn't heard of that book.
Just to wrap up, I think the last thing I wanted to talk about was that there was an article in Investment Executive last week, and I saw the guy who wrote it tweeted it. I wasn't too familiar with him, so this looks interesting, and I went and read it. It was terrible. I actually sent an email to Investment Executive to say it's for a column. I can't remember what it's called, but it was for a column where I think industry professionals write about stuff. So the article was so bad that I emailed Investment Executive and said, like, if this is the kind of stuff you guys are publishing, can I write for you too? Because I'm sure I can do better. They're going to get back to me. They're about to publish their September issue. But anyway.
It's kind of like we got Angry Ben today.
I'm not angry.
Fired up Ben. How's that?
I'm happy. So anyway, the author of that article talked about, the point of the article was that socially responsible investing, or responsible investing as he calls it, gives you at least as good as, if not better, returns. So socially responsible investing, he's arguing, gives you at least as good as, if not better, returns than traditional investing. It was framed to be a very evidence-based type article. It cited an academic study, though, which I dug into, and it was, it just makes you laugh. So the study was based on a list of funds that his company, so he's got like a socially responsible investing consulting firm or something. As far as I can tell, they like certify mutual funds. So if I'm a AGF and I want to be certified as responsible, they'll certify you. I think something like that.
Okay.
And then as an advisor, you can also get a designation from these guys. So anyway, the study was done with their list of approved funds. So there's obviously biases in there. But then I read the study, and it had zero correction for survivorship bias.
Which is?
Well, it's taking into account funds that no longer exist. If you look at a list of funds today, just by nature of still being in existence, they will be the funds that have done well.
They're the successful ones.
That's right. Whereas a bunch of funds, and if we look in the last 10 years in Canada, about 50% of funds have closed.
Yep.
Presumably due to poor performance. So anyway, the study said 63% of funds beat their benchmark, of responsible funds beat their benchmark. It's like, what the heck? So because they're responsible, they're going to beat their benchmark? It doesn't make any sense. But it didn't correct for survivorship bias. So that was my first issue with the article. But the bigger issue, and I've written about this in the past, is that socially responsible indexes and funds, they tend to accidentally focus on factors. Here we are talking about factors again. But they accidentally focus on factors that explain returns. So I did regressions on the indexes that this article referred to. It showed the MSCI ACWI versus the ACWI ESG, so the socially responsible version of the ACWI, and it also showed the S&P TSX 60 versus the JANSI, which is a Canadian index of socially responsible stocks. So I ran regressions, and
I think everybody knows where this is going, but go ahead.
Well, the difference in returns, because the article says, well, these social indexes did better. The difference in returns was fully explained by exposure to the profitability factor.
Right.
And in this article, he does actually quote a study from MSCI that says socially responsible companies tend to have higher profitability. So it's like, okay, but they're not having, you don't get better returns because they're socially responsible.
That's not the explanatory factor.
Correct. It's just profitability. So
if you want profitability, buy profitability.
That's right. Instead of accidentally getting it by way of, because the thing is with socially responsible investing, you might not always get profitability.
Right.
So if you want profitability, you go target profitability. Anyway.
But it's not fulfilling all the objectives of the investor. If you have an objective, if you get utility out of knowing you're perceived making a difference with your investments, there's no fulfillment in that by going for profitability stocks.
Correct. Yeah. So that's a reason to invest this way with social responsibility in mind. If that makes you feel good, that's a whole other story.
The big problem is that you're not really having an impact on the company by not buying its stock.
None.
And you're actually ending up in a higher MER portfolio. So why not just cut the MER and go take that savings and go make a donation, a targeted donation to a...
Where you can have a direct impact on some organization, and if it's a registered charity, you even get a tax credit. But you start thinking about people who don't want to own those types of stocks, and if you feel sad about getting profits from a firearms manufacturer, that's fair enough. But maybe a more responsible way or a more sensible way to approach it is to own a low-cost index fund, accepting that you're going to own some companies that you may not agree with, but then take the difference in cost and go and donate that directly to causes that are important to you. Seems to me to be a more sensible way to approach it.
Agree. Anything else on your mind this week?
Nope.
All right. See everybody next week.
All right. That's it.